We are back with David Burrows and taking an email here from Florence in Dorval, Quebec. It's on Nike. She asks, I'd like your opinion.
Great. So Nike, first off from the top, of course, comes in the consumer discretionary sector, the largest brand for athletic footwear in the world. This fits squarely within our theme of the consumer spending money. Nike is a dominant brand. They're obviously around the world. They've done an amazing job of taking that brand and pushing it out, not just through shoes, but clothing and so on. In the last couple of years, they've done a great job at selling integrated lines where somebody might buy a basketball jersey and shorts and socks and a hat, along with a pair of shoes, all coordinated. They're buying back lots of stock. They're generating a ton of cash, so they continue to invest to become more and more efficient in the business. And they're achieving, double-digit growth in China, close to 20% growth in Europe, 15% growth in the U.S. So in a world where growth is hard to come by, Nike's doing a great job. And so this is a company we own, and it's one that I would buy here.
Okay, just looking at the price earnings ratio, you're clearly not disturbed by 27. We're looking at Under Armour as well, comparing that company against Nike, and that I'll take a look at the PE on that one. Does that intrigue you at all, the growth potential there, or is it just too rich?
Do you know the thing? And certainly Under Armour, fits in this category the same way. I think that one thing you have to remember is that valuations are always relative, and sometimes you have to pay a premium price for a premium product. And so we believe that we're in a world where multiples are expanding, and so long as Nike continues to execute, multiple can actually probably expand from here. So you pay a high multiple for the highest quality company in the group, and I think that fits.
Under Armour trading at 92 times estimated price earnings ratio. We have Alok, who is in Brampton. Hello.
Hello, Mark. Thanks for taking my call.
Sure.
Good afternoon. I have some question to your guest, David, about the Bombardier, or the pros and cons.
Well, I have to tell you, I don't see much by way of pros. Now, Alok, in fairness, our strategy is very straightforward. We try to find these neighborhoods or areas of market leadership, and then within those areas, we try to find the best businesses, the one with the strongest balance sheets, the ones whose numbers point to things going well and getting better. We never try to buy broken, hoping that it will get fixed, because if you're wrong, you wind up with a world of hurt. We also like to see price behaving the way that it should be if things are getting better. In the case of Bombardier, the numbers are getting worse. The balance sheet is not good. The price is doing exactly what you would expect it to do if things are getting worse. And there may be somebody who's brave or smart enough to pick the bottom in this. It's not us. I just would tell you to avoid this. We're in a market where there's some wonderfully performing stocks and some great clear themes. If you want to be in aerospace, look at Northrop Grumman, that's selling into the U.S. defense budget. They've got the greatest focus on U.S. spending of any of the defense companies. They've got a chance to win this long-range strike bomber program, and stocks behaving very, very well. U.S. defense budget's going up. I would focus in that part of aerospace as opposed to the part that Bombardier is in.
Now there's Northrop Grumman, and you said you hold this, or you?
Yes, we do.
Yeah, okay. Here's Ken. He's in Ottawa. Hi there, Ken. Good afternoon.
Hi. Thanks for taking my call. David, I was looking for a U.S. stock that would be safe and yet I figure would have some growth in it. And I narrowed it down to Apple and Goldman. And I chose Goldman, but I just wondered what you thought of my choice. Thanks.
Sure. So, Ken, we own Goldman Sachs in our portfolios. So if you think about the themes that we talked about, financials are a natural winner. If you think that interest rates could be rising going forward, albeit slowly, the financials are the one sector that tends to have a positive correlation to higher interest rates. Because as things get better, the financials tend to do better. Now, within the financials, the most aggressive part is really the broker-dealers because they are more tied to the stock market. Goldman Sachs really is sort of the king here. They're very efficient with their capital. It's a different business than it was before 2006 because, of course, they've had to get rid of a lot of the proprietary trading. But if you think that the market's going to do okay, and if you think that investment banking is going to continue to expand, and it is right now, and M&A, then Goldman Sachs should be a natural beneficiary. The group broke out in the early part of June to new highs and has pulled back over the last few weeks. It's a natural pullback. I think you buy the stock here, it's sitting not far above its 150-day moving average. And we own both Goldman Sachs and Morgan Stanley in this group, and I think you do well in this group.
You described the secular bull market that you think we're in. How long can it last, do you think?
Well, secular bull markets tend to last, 15 to 18 years. And you get natural interruptions, like in the 80s, we had 1987. You had to watch out for that. You had 1998 and the 1990s and the Asian currency crisis. But there are signs that you watch for those types of corrections. But I think that this can go on a long time. I think we broke out to new highs in 2012, which took us out of the trading range we've been in 12 years. That was the beginning of a secular bull market. And so I think we probably have 10 years in front of us of stronger equity returns, especially for consumer-led markets.
That's what makes the market. We have some guests who are very bearish right now, so it's fascinating.
Don't confuse the short term with the longer term. I do think that there are some very near-term risks, but at this point, the leadership is intact. There's some big risks for some sectors that are underperforming and are having a real problem, like energy, for instance.
Yeah, my point was that we do have some guests who basically think we're at the end of the line here and we're ready for a bear market. We'll come back with David Burrows and more of your questions after this.